Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive Owen LLP and the York Press. It's been a rocky start to 2025 in the UK. The GDP growth forecast for 2025 has been downgraded to 1% from earlier prediction of 1.5%. The latest UK inflation rate from December last year sits at 2.5%. Over in the US, the Federal Reserve has held interest rates, while the Eurozone has cut its base rate by 0.25%. But we're yet to see the real impact of the Trump tariffs, which are already impacting Canada, China and Mexico. Well, they've been announced. And here in the UK, Donald Trump has said he's yet to rule out any tariffs on British businesses. But what do our members of the Shadow MPC think? It's time to cut interest, maybe? Well, they're currently at 4.275%. And would a cut avoid stagflation? It'd be good to see our regional economy prosper, and how are their sectors, and is it stable? Is a rate rise maybe the way forward? Let's talk to members of the Yorkshire Shadow MPC. Let's kick off with, I tell you what, let's kick off on employment today. We've got Kerry Hope from Castle Employment. Kerry, look, you're at the front edge of the economy, aren't you? Because people with vacancies are going to come to you. Have you been receiving more or fewer vacancies than in recent months?
Recent months, businesses are definitely more cautious than they've ever been about hiring. All the recent data suggests that, and we've definitely seen a decline in permanent staff appointments. December 2024 experienced the fastest decline since August 23. So we're definitely seeing businesses being impacted by increased employment costs and the uncertainty falling after the budget.
I think people want to see how it lands, don't they? I've had in my business a vacancy arisen as someone's moved on to another job, but I've not decided to fill it with a full-time member of staff yet, rather a fixed-term contract. A very good person, but fixed term, just until we see what the outcome of this employer's NI coming down the track for April does do as far as impact. Is that something that you were experiencing with other employers?
Absolutely. We've had an influx of temporary requirements. So as has the market, we're part of the REC, the Recruitment Federation, and they're seeing an increase in temporary and a decline in permanent, all because of the reasons you've just mentioned. Alongside that, there's obviously rising staff availability. So thinking about redundancies, thinking about, why people are out there. It's making hiring fixed term and temporary easier than it was before.
All right, let's pick up from Carl Wright at Clive Owen LLP. Carl, rather like Recognition, but much bigger. You deal with a range of different companies. What's the sentiment you're hearing from your family-owned businesses?
Nervousness, Graham, absolute nervousness. I think just to hit on everything in terms of investment, whether that's in people, whether that's in capital projects, whether that's in R&D. And that really correlates with what our institute, the ICAW, have reported in their business confidence monitor. So the Q4 2024 number showed a big drop. It was positive 14.4 all the way down to basically zero. And at a regional level, the Yorkshire and Humber monitor actually dropped into negative territory at minus 5.6. And that is actually despite some actual good news on the domestic sales front in particular. Yorkshire and Humber respondents, their sales for last calendar year were 4.2% positive. They're projecting forward of 4.6%. Export sales, on the other hand, have weakened significantly. Only 1.7% growth last year. I expect if you'd asked those respondents again today, there'll be significant nervousness going forward, given what we've had from the US in terms of tariffs over the weekend. Profits were actually up as well, 3.1% for the year of December, and it projected to rise 5.5%, by 5.5% for the year ahead. So it's a real mixed bag of data, and it's a little bit contradictory. But why is confidence so low? Well, the single biggest issue by a mile is the employer's national insurance uplift. It's gone. Business taxes were an issue for 31% of respondents in Q3. It's now a 62% of respondent issue in Q4. Regulatory matters, trading frictions also playing a part, particularly around exporting to the EU. Getting goods out continues to be problematic. And as I said, clients are holding off on employment, on capital investment, on R&D projects. We heard from the Chancellor last week with the somewhat accelerated growth plan. I think it's fair to say that's been met with a muted response in the region, with any lack of any significant announcements for Yorkshire. It looks like it's going to be left to the regional mayors and combined authorities to drive the local growth agenda. My day job, sort of speaking with businesses that are looking to invest and helping them get grant support. Uncertainty on that front as well. The business support agenda seems to have been kicked down the line by 12 months in the annual statement. They've rolled over some existing support schemes that were available under the previous government with some sort of excess funds that weren't spent. So again, not great for the region's SMEs that are looking to grow. And I think businesses have come through a lot, haven't they, over the last 5 years. They thought some stability was potentially coming along once we got election year out of the way. It really hasn't materialised, and the big hit on the employees' national insurance has really caused a lot of dissatisfaction, a big drop in sentiment, and I think there's a real need for some sort of support from somewhere to sort of drive that confidence.
All right, well, Carl, that's a very helpful set of opinions backed up by some data and a snapshot of where your clients are. Thanks. We'll come back when we get the votes and ask what you're going to vote for and why. Dave Broadbent from Begbie's Trainer, one more snapshot. Now, you remind people what you do because you're on the sort of more difficult end of business advice, aren't you?
Yeah, thank you, Graham. Yeah, so I'm a licensed insolvency practitioner. I cover both the Yorkshire area and Teesside as well. We are continuing to be incredibly busy. I can't recall a month when I actually thought, do you know what, we've got time to take a breather and have a look at what's happening. Hospitality sector in particular, and that's one of the sectors that we are seeing a big impact on, especially what the guys were saying earlier about the employee side of things. The problem is you've got twofold, got two issues caused as a result. One is the fact that most businesses within that sector and others that we're looking at have been impacted by the recent budget, and it's added just a cost base, which was never there with no growth there. And then secondly, those businesses that have been run well but are small, so 3 or 4 employee businesses, are struggling now because they're in a situation where turnover levels or costs have increased or turnover levels have dropped to an effect that they have to shed some form of cost base. And the problem that they've got is that the only cost base they can probably get rid of is a member of staff. And when you've got staff members that have been with a firm for a long period of time, unfortunately, that does create a large redundancy cost that most of these businesses can't afford to meet. So a bit like Carl was saying before, I think the government's going to have a real good look at the small business sector and see how that's going to be impacted this year. We still continue to see businesses that are struggling with the debt that they accrued back in 2020 as well. So something's going to have to happen, or else we are going to be in for an incredibly busy year.
All right. Well, Dave, thank you for that. I suppose I'll give my little analysis of where the economy is from my own business point of view. I might be the only person to say something positive, because maybe we'll go to Gary for something positive too. At the front end of the economy, PR, marketing, maybe Steve's got a view. We've actually had quite a few inquiries of people trying to do something about it, realizing that actually there is a difficulty ahead and they've got to get smart and they've got to market and they've got to get ahead of the game. And there's been also quite a few planning inquiries to work on, because people are putting planning permissions in the hope or expectation that the mood music of faster planning will result in some new kind of results. And I do detect that January has been more positive than I expected, but I did expect it to be a little bit subdued, so maybe that's not a brilliant thing. Steve Lowe, what about you? You're at the front end as well, with people marketing and advertising in the papers.
Yeah, I think we've had a mixed start to the year. Public sector spend is halting if it doesn't have to, which flows through. Education sector as well, the VAT impact now coming down the line, and then obviously the cost with national insurance has been a bit negative. Retail's been okay. I mean, Dave said that hospitality, but we've had a decent start, and I think maybe to your point, there's a few more trying to market themselves forwards a little bit. Property sector for us has been okay, but property prices are starting to halt a little bit. cautious would be where I'd say our position is at the end of January.
That's how I feel. I feel cautious but irritated. We shouldn't have had to be this way, but that's another matter. Becky, from the CBI, what have you got to say? What's your dipstick of talking to your members in Yorkshire?
Hello, everybody. Well, we published our growth indicator last Monday. I'm afraid it was fairly pessimistic, with sort of private sector growth up to April. Actually, it's expected to be around the weakest for 2 years. And with pessimism pretty widely shared amongst sort of many sort of areas of the business community. It isn't every area, and as you say, there certainly is always pockets who seem to buck the trend, but I think generally it has been quite negative. Obviously, impact of the budget is quite a significant factor in that. And I think sort of looking forwards, people are worried about what the Employment Rights Bill is going to have on their business, their hiring intentions, and also their ability to sort of deliver some of their sort of plans. It is impacting sort of that sort of cost of doing business is impacting on investment plans as well. So it does feel like a really tricky picture in that sense, really. And yes, and obviously we saw the speech by Rachel Reeves on last Wednesday. And yes, it had some really good stuff in it, but yes, I would absolutely agreed that it didn't seem that great for our region. And when you talk to so many business. Sorry?
I mean, the biggest business in the country is the amalgamation of all SMEs, and it felt like a lot for big construction and a lot for big operators and a lot for power and a lot for transport, but not necessarily a lot for SMEs.
And you hope that would eventually trickle down to SMEs, but that takes time, that trickle down, and that's the problem. I think a lot of people thought it was very long-term sort of announcements. What about here and now? They want to see some delivery sort of here and now. I think that was some of the feedback that we got.
Okay, now we're going to go to Gary from Evelyn, Gary Smith. You can give us an holistic view as well, and the Trump stuff is interesting. People are getting their knickers in a twist about Trump, and understandably so. And some of the reporters are not distinguishing between punitive tariffs on things like countries that are allowing illegal immigrants and so on, and reciprocal tariffs, which is where if the EU tariffs 10% on a car, he's going in a tariff 10% on a car. So it isn't as the blanket tariffs haven't been announced yet.
No, it's a happy new year, everyone, and good to see you all. It's certainly been an interesting start to 2025, following quite a, I would say, pessimistic end to 2024. So in terms of the tariffs, they were expected, and as you quite rightly said, some are for political reasons in terms of drug trafficking into America, illegal immigration trafficking into America. But a lot of it, if you look at the tariffs that are being levied, it's where the US is in trade deficits with the countries that they're applying the tariffs on. And it's very much trying to promote buying US products rather than overseas products that will hopefully generate a growth, make America great again, generate higher salaries. But if you cut people's income tax and replace it with tariffs, well, you might be 20% better off, but if the goods cost an extra 20%, you're actually no better off. So we'll have to see. It looks like the EU is next on Mr. Trump's radar. The UK may not actually get any because we are actually in a trade surplus with the Americans. So America actually exports more to us than we export to them. So it would be shooting yourself in the foot if you were to put tariffs. So we'll have to see what happens there. In terms of investments, and this does sort of lead into tariffs, last year, most of the growth in global stock markets were driven by the Magnificent Seven, who are predominantly AI-generated businesses led by the rapidly growing NVIDIA, who make microchips for AI computing, and who became the largest company in market value towards the end of 2024 and have been trading on a daily basis. Who was going to be top? Well, when a Chinese company introduced an AI tech that matched what the US already has at a significantly lower cost, Nvidia share price fell 30% last week, and that was round about 500 billion. So we have been diversifying, moving investments away from this Magnificent Seven and into a broader mix of investments. But on the whole, in the UK, it has actually been a benefit to the FTSE 100. Before today, the FTSE 100 actually hit its all-time high last week, and a lot of that is money being pulled from tech companies and investing in, dare I say, more boring, plain vanilla companies that generate dividends and have more solid returns. But on the ground, there's general anger with the people I deal with, a lot of business owners, a lot of farmers, a lot of employers. So the increase in national insurance that will come in is probably likely to be inflationary. And the reason we saw global markets come off was inflation is likely to be a bit more sticky, and therefore central banks won't be able to reduce interest rates as quickly as anticipated. And I am very well aware of people I deal with who are pulling capital projects within their businesses because, one, they're fed up about the inheritance tax that'll be paid. Why should I grow my business to pay tax? Some will look to sell and exit. And a lot of, and the word I keep hearing is unintended consequences of the budget announcements that will result in millions of pounds of tax being paid for these inheritance tax costs during lifetime, not on death.
Yeah, people don't understand. It would be a whole podcast or a whole show to explain it. How do you pay inheritance tax during your life? You're not dead yet.
Mm-hmm.
Can you do it in one line, Gary?
No, it's too complicated, but there are people who, and we're talking millions of pounds here, that would be that. And there's genuine anger about pension savers as well, because they will be hit. But there's been a consultation period that has now ended. We are waiting for some legislation. At the minute, it's very difficult to advise and give people guidance because we haven't yet seen the legislation. We think we know what will be coming from April 26 and April 27, but there is no legislation. We look forward to seeing the finance bill, hopefully in the next few weeks, with royal assent and to becoming legislation later in the year, because then we can plan.
All right. The one observation I would give on people investing, and you're an investor advisor, but the government, because of the amount it's borrowing, its bonds are quite well priced if you want to invest, and that's going to suck your money away from investing in businesses because you're getting a decent return, and it's tax-free.
It's more the worrying thing is that the 30-year gilt. So if the UK government wants to borrow money on a 30-year basis, they are having to pay 5.5% annual interest on that. Now, that just shows you what investors think of the long-term prospects of the UK.
Yeah. Okay, let's pause it there. Let's put everyone on the screen, and we're going to go for the vote. And then as soon as we have the vote, one line each on why you voted that way. So the question is, does anyone on this panel wish to see interest rates increased in the Bank of England decision later this week? Hands up, please. No. Does anyone in this panel wish to see rates come down by maybe a quarter of a point or more if the Bank of England took a vote this week? Okay, that's 4. Okay. Oh, it's 5. Right. Okay. And who wants to see a broadly hold position? Gary and Dave. Okay. We'll go round, and the question is why. Gary first.
I think the national insurance increases will purely be applied in terms of prices, so that will be inflationary, and it's too early to reduce interest rates.
Okay, fair enough. Dave next.
Yeah, similar to what Gary's just said. I think it's too much of an impact that what we're seeing at the moment. There's far too much going on to add in another issue of increased interest rates.
All right. My view on reduction of interest rates is that we would put some headroom in for businesses to actually get their projects off the ground and defy the government's tax rises in a way. But that's my view. Let's move to Becky. What's your view, Becky? You hesitated before you put your hand up, I saw.
Yeah, sorry, because I misheard you. We do think there'll be a cut, really just to give a little bit of wiggle room to people, and I do think that some of the NIC will be manifest itself in price increases. Don't think all of it will be. We're talking to a lot of businesses who are trying to absorb some of it.
And you want a cut? To be clear, that's
Yes.
your view.
Yeah.
Right. Kerry Hope from Castle Employment.
Sure. A cut in interest rates for me, please, and I believe it would help stabilise and encourage some investment.
All right, from Clive Owen.
Yeah, I hear the point about the employers and ICs. I think I'm with Becky. I don't think it's all going to flow through to pricing. Service sector inflation has cooled off a little bit, so I think now is the right time to stimulate that investment that we need, particularly in the SME community.
Interesting. All right. And Steve Lowe from NewsQuest, Local IQ, our partner on the York Evening Press. Or the York Press.
We deal predominantly with SMEs, and giving them a little bit of financial headroom is why I would reduce them.
Okay, well, that's great. I think we've got all the panel. Have I missed anyone? I don't know if I have. No, we've got everything. Thank you, everyone, for taking part. So the Shadow MPC from the Yorkshire business community, for the first time in recent months, has gone to recommend a cut in interest rates when the Bank of England meets later this week. Thank you to all, and we'll see you in a few months. Thank you.